Welcome to PhillipCapital's weekly market watch. Crude oil has seen a roller coaster year in 2008. Global deleveraging and recession put the brakes on oil prices. What are the reasons behind oil's dramatic fall? Today we have Mr. Adrian Koh, Associate at Phillip Futures, to share with us. Adrian, what are the possible reasons that oil prices have fallen faster than they have risen?
Okay, basically this year, the year 2008 was a very good year for crude oil. Basically, there were a number of records set. It rose to the record high of $147 a barrel, and it actually came down even faster rate and falling over 53% on the year. So basically, there are a number of factors affecting the fall in crude oil prices, including demand destruction. This slowly unraveled as the financial crisis worsened, and we also have other factors such as the gasoline cracks are actually in the negative regions, which makes refiners very reluctant to produce gasoline, which actually leads to actually lower use of crude oil.
Recent supply cuts by OPEC and major oil-producing countries did not put any significant pressure on oil prices. If supply is no longer a major factor, what else could affect oil prices?
Okay, basically the record cut in supply production begins in January, 1st of January this year, 2009. So basically what we have now is we will start to see the supply cuts beginning to come in. So once we get actual figures from OPEC that actually shows supply is actually beginning to come down a bit, then we'll probably start to see crude oil probably being supported, and perhaps it could start moving higher in the near term. But now we do not have any actual figures. So once we actually get those figures, probably we'll see the disparity between supply and demand actually narrow down. So the other factor we can look at is also the risk aversion factor. Crude oil has actually come down a lot because of the financial crisis. People talk about demand destruction. So hedge funds are deleveraging. They are moving the assets from commodities into other safer assets such as treasuries, as well as holding cash. So that's one reason that's actually kept crude oil prices a bit pressured at the moment. Then the last factor we have is also building inventories. Inventories are actually moving upwards, moving higher. That actually means that demand is actually slowly moving down. That is also actually causing crude oil prices to actually come down quite a bit.
With oil prices looming around $40 now, would it be a cheaper trip to the kiosk this year?
Okay, basically from a technical perspective, the $25 to $30 regions actually provide very good support for crude oil in the near term. Now that we've moved above $40 as of New Year's Eve, the $40 support actually provides very good support in the near term. The $50 regions actually provide very strong resistance, and if we do move above the $50 and make a significant break above those regions, then we could probably see oil retest maybe the $75 to about $80 regions in maybe the medium term. There are a couple of factors we have to look out for to actually see whether crude oil is bottoming, or maybe we could see a strengthening of crude oil prices. These include probably the actual figures of OPEC's record cut in production actually start to come in. Then we could start to see other non-OPEC countries start to reduce supply. This could also be supportive for crude oil, as well as the current Middle East tensions between Israel and the Gaza Strip. These are actually supportive factors for crude oil.
Thank you, Adrian, for your time. That's all for today. Stay tuned next week for more market updates.